I'm going to show you how a technique that was invented by professional gamblers can be applied to quantitative trading and investing. Specifically, this is going to show you how to find the optimal position sizes to trade when you're allocating your portfolio across multiple different assets or strategies. So a quick disclaimer here, this video is for educational and informational purposes only. You should always seek professional advice for your specific situation, and this technique and trading in general is going to involve risk. Okay, with that out of the way, let's jump into the problem statement. So our situation here is going to be that we have multiple diversified strategies or securities in our portfolio at the same time, and we want to figure out how to split the cash between them. It doesn't actually matter whether these are separate algorithms or different stocks. As long as they have returns and volatility, then we can model them the same way. And the goal is going to be to determine the optimal fraction of the portfolio to allocate to each one. And by optimal, I mean the allocations that are going to maximize our long-term wealth, or more precisely, give our portfolio the highest compounded growth rate. The solution to this problem is captured by an equation called the Kelly formula, which is going to give us our optimal bet size. Now, this formula is famously used by investors like Warren Buffett and Bill Gross of PIMCO, but it was invented by this guy on the bottom right here named Ed Thorp. And Thorp was a former MIT professor and professional gambler who was actually one of the first people to use his math education to tilt the odds at the casino in his favor. So later on, he founded a hedge fund and he used the same principles to beat the market for 20 plus years. And in this video, I'm going to explain the formula that he used in plain English, and then we'll go through some Python code examples so you can see exactly how to calculate it and use it for your own trading. So let's talk about some assumptions the strategy makes when calculating the optimal sizes. First of all, it supports the use of leverage or borrowed money to maximize return, which means that it often finds we get better compounded growth by, for example, doubling our portfolio size. But of course, this is adjusted for risk, so we don't actually blow up our portfolio by taking on too much leverage. On that note, another assumption it makes is that the probability of ruin must be zero. So ruin is a dramatic way to say your portfolio going to zero, which is obviously bad. And this assumption is actually mathematically important too, because without it, you might find that the best way to optimize your portfolio value is to bet everything on maximum leverage all the time. And if we make the assumption that we can never go to zero, then we avoid that obviously flawed strategy. So it's kind of like outsmarting the optimization genie who would otherwise take things too literally. Now, the most important assumption that we're going to make as a user of the Kelly formula is that the model of the returns for our strategies are normally distributed, like the chart in the top right. Okay, so a normal distribution is when you have a central mean and then values kind of naturally and symmetrically move away from that mean. So in real life, strategies will not always be normally distributed. You definitely have more instances of fat tails or extreme events in finance than people think. But still, this is a pretty common and acceptable assumption to work with, especially when doing mathematical modeling of a financial market. So to introduce some symbology, here we're going to say that the returns of strategy I are represented as MI, that's the average return, and the standard deviation is going to be SI. And lastly, the vector of optimal allocations that we're going to calculate is going to be represented as this F star here, where each entry in that vector is the optimal allocation percentage. Now, I know this is a little bit mathy, but basically all this is saying is that if you had 10 assets in your portfolio, this would be a list of 10 numbers, each one representing a fraction of, a percentage that you're going to ultimately allocate your cash to. Okay. One concept you should understand first is that of covariance matrices. These look fancy, but they aren't as scary as they seem. First, a covariance is going to be a measurement of how much two strategies or securities are related to each other. It's usually bad to have high covariance when it comes to investing because it implies a lack of diversification. Then the covariance matrix displays these values between every single strategy in the portfolio. So you can imagine that the entry at position, let's say IJ, right, which would be the first, I is going to be your rows and then J is going to be your columns. That's going to represent the covariance between asset or strategy I and asset or strategy J. Now you'll notice that if I and J are equal to each other, then the entry would lie along this diagonal here. Okay, let me draw this out. So the entry would lie along this diagonal. And if that's the case, then the covariance is going to reduce down to just the variance of the asset itself, because the covariance of an asset and itself is its variance. Okay, and that's the volatility of the asset. So if this is still confusing, we'll make this tangible with an example in just a few slides, but I wanted to cover this up front because it's a key component of the Kelly equation. So with that understood, this is the equation for the Kelly formula. So on the left here, we have our F star. That is our list of Kelly fractions that we talked about earlier. And then on the right-hand side here, we have an expression C to the minus 1 times M. So C here is going to be our covariance matrix. And then this minus 1 here isn't an exponent. It actually means inverse. So we're going to take the matrix inverse here. If you're not too familiar with what that is, it doesn't actually matter too much because we'll just be able to calculate it and then move along with our lives using Python. Okay. And then M here is going to be a vector that represents the average return of all of our different strategies that we're going to trade. So what'll happen when we do these matrix and vector operations is we're going to take a full matrix here, the inverse of C, multiply it by a vector of values M, and then ultimately get out another vector of values F. When I say a vector, again, I just mean a list or a row of values, one for each strategy or asset in the portfolio. Now, intuitively, we see that this strategy is going to weigh our allocations by the returns of the strategies while effectively adjusting for how volatile they are and how correlated they are to each other. Now, if we only want to trade a single asset, or if all of our assets are uncorrelated, then the Kelly fraction will reduce to an even simpler expression. Here, we say that our fractional allocation of an asset I is simply equal to the mean return of that asset divided by the standard deviation of that asset squared. And we'll use this expression to calculate the hypothetically optimal leverage for a single asset portfolio like SPY in an example. So now that we have that math and theory out of the way, let's get our hands dirty with some actual code. So this first example will be for the single asset case I just showed you using SPY by itself. And it doesn't actually have to be SPY. We're just going to define some hypothetical return and volatility numbers for it. And you could replace the asset with whatever thing you'd like to pretend that it is. But in this case, we're going to assume that the mean annual return is 11% and the annual standard deviation is 16.9%. We'll also assume a risk-free rate of 4%. Then we can trivially calculate the excess returns by subtracting the risk-free rate from the annual returns and the Sharpe ratio by dividing the excess returns by the standard deviation. And you can see here that our basic excess returns are 7% and our Sharpe ratio is 0.42%. And then we can take that expression that we saw in the last slide for a single asset case and say our Kelly optimal leverage or Kelly optimal fraction is going to be equal to the excess returns divided by the standard deviation squared. It's a very simple expression, and we get an optimal leverage or allocation value of 2.52. So when we compare the growth of our leverage portfolio to our basic portfolio, we see that we get an excess return on the leverage portfolio of 16% over the base one of only 7%. And that's the power of Kelly. Okay, we can take this to the next slide and we see that difference visualized. So here's a simulation that's going to run over a 5-year period. You can see the x-axis is the number of days with 252 trading days in a year. And the difference between the Kelly portfolio and the one without is quite pronounced. So while there's clearly additional risk associated with the leverage, it still makes a big difference in terms of how your portfolio is going to grow over the long term. Now let's generalize to the multi-asset case. So we're going to use Finance to load price data in from Yahoo Finance into a Pandas data frame. Okay, so this code is very simple, right? We just call yf.download. And in this case, we're going to use 3 stocks, Apple, Netflix, and Google from 2010 to 2020. These are completely arbitrary selections. I just picked 3 random well-known tech stocks, and this date range is a full decade, so it seemed reasonable, but it has no bearing on the strategy whatsoever, really. Then we're just going to drop all the null values, and when we do that, we end up with 2,516 rows. Then we'll do some familiar transformations on the data. So first, we want to convert our close prices to our daily return. Very simple. We just take the adjusted close column and call this percent change function on it. Then we want to take our daily returns and convert that into excess returns. So again, assuming a risk-free rate of 0.04, we just divide that by 252 for the trading days in a year, and then subtract it from our returns to get our excess returns data frame. So note that everything we do in the coming parts will be framed in terms of excess returns. We can see the distribution of our excess returns for the 3 stocks in questions. This is mainly to eyeball how normally distributed they look, which I would say is pretty good, roughly. You will notice that based on the axes here, for example, there are some outliers in Google, but yeah, these look normal enough for me to kind of move forward with. So you'll recall the expression before, C inverse times M. So we'll need to calculate C and M, of course. So M, as we said, was the average return of each individual stock. So here we just take our excess daily returns, calculate the average, and then annualize it by multiplying it by 252. And you see for Apple, Google, and Netflix, we have our 3 different average return values. Then to get the C values, we will simply do excess returns.cov. So we get our covariance matrix, and again, we are going to annualize this by multiplying it by 252. And here we get our 3x3 matrix, where we get the covariance of each asset as we would expect it to be. It's very, very easy to do this in Python. Finally, we can get our results based on this. So you can see we're going to use some linear algebra utilities from NumPy to do the multiplications and to calculate the inverse matrix of C as well. And this is ultimately going to recommend that we take on 2.97 times leverage on Apple, negative 0.13 leverage on Google, which is going to be a short position, and 1.44x leverage on Netflix. And again, let me clarify, when we say optimal fraction as we had before, Kelly isn't necessarily going to constrain those values to be, quote unquote, actual fractions that are less than 1. So when we talk about, optimal fraction or optimal allocation, we are implying that leverage can be used. But of course, you can always normalize these values so the proportions stay the same while the sum of the values is ultimately 1. All right. So here's a question for you to ponder, right? If Netflix's returns are so much higher, right, 47%, versus Google's returns, which are only 23%, versus Apple's returns, which are only 23%, why does the Kelly formula recommend using so much more leverage on Apple than it does on Netflix? Okay? And the answer is that if we look at the covariance matrix, Netflix has a very high volatility at 27% versus Apple's, which is only 6%. So even though Netflix's returns are also great, the risk reward of it isn't high enough to justify as much leverage under the Kelly formula. And that's the real power of this. So lastly, you might be thinking, how does this portfolio actually perform then? And I'm going to hand wave over the equations here for the sake of time, but these are just going to convert our allocation matrices to the compounded growth rate and Sharpe ratio like we did before for the single asset case. So you can see here that the compounded growth rate that we get for our Kelly fraction is 71% over the 5-year period, which is exceptional. And our Sharpe ratio is 1.16, which is also quite good considering the volatility of the underlying assets. Now, don't get me wrong, we'd all love to have a time machine and invest in Google and Apple and Netflix in 2010, since we all know how much growth tech has had over the last decade. But we'll see that these particular allocations are going to outperform the growth rate of any particular stock by itself. And here's the proof, right? We see that Netflix does have the highest compounded growth rate at 39.8%, but that's only half of the Kelly strategies, which is ultimately 71%. So again, I'm not going to make any statements about volatility or especially drawdowns right now, but if the objective is generally to maximize your long-term compounding, this is the mathematically proven way to do it. So if you actually want to put this into practice, there are a few other things you should consider when you're doing so. The first one is if your equity changes, you should rebalance your portfolio to mean the Kelly sizing, right? The leverage that you use is going to be a function of your underlying equity, not your overall portfolio value. So if you make gains or losses on your equity, then you'll find that your optimal portfolio value is actually a multiple of those gains or losses, right? Also, in practice, you might find that the amount of leverage that you can use is constrained by your broker. And if that's the case, you can always normalize your Kelly fractions by whatever that maximum amount of leverage you can get is. And I want to reiterate one more time that the assumption Kelly makes is that your returns are normally distributed. And things can definitely fall apart if that isn't the case. So while tail risk is always dangerous in finance and trading, it's doubly so when leverage is involved. So in practice, many people prefer to reduce their risk by using a system called half or quarter Kelly betting, where they simply take the optimal fractions and chop them in half. And if you do this, you get to keep your optimal proportions the same, but it's as if you're trading a portfolio that's half the original size. And this can help a lot with the drawdown side of things, since you'll have less likelihood of taking a big hit on a one-off unlucky bet. So if you want to grab the code from this video and continue the discussion with me and other algorithmic traders, it will be posted in our free algo trading community. You can find the link in the description. It'll take you 30 seconds to sign up and get access to all of this, plus all of our other free resources on quant trading and Python. All you need to do is go to school.com/algos to apply completely for free. So I hope to see you there, and I hope you enjoyed the video. Bye.